Fine. How many participants we are having in? We have around 550 participants joined in from different Zoom meets. And as we were discussing and all, and we have been talking about the markets, about the different scenarios, about the different gaps, and about the market returns for the different market gaps. So I have one question for you, and that question is very general question. And I would just like to have your views upon the same thing. Okay. So just give me your views upon one question. So one simple question, simple and tricky one, right? So it is not a difficult question that you guys have to think about a lot, but it's a tricky one. So we all know like about the markets, and everyone has been talking about the markets now, especially about the different market caps, right? They have been talking about the large caps, the mid caps, and the small caps. So currently, the matter of discussion in the market, as we see in right now, is about the different market caps and how much return these different caps have given to the investor respectively, be it the large cap, the mid cap, or the small cap. And one thing also we know that over the past 1 year, or if we talk about on a YTD basis, that is from January to December as of now, where we have the session 12th of 9th of December, the mid cap sector has given around 35 to 36% return YTD basis. And the small cap sector has given around 40 to 43% return. The mid cap stocks and the small cap stocks have rallied a lot. The previous rally that we saw in the mid cap and the small cap stocks was around 2017 to 18, where again these mid cap and the small caps rose by 30+% and 40+% respectively. People have been commenting about these mid caps and small cap sectors being overvalued, being trading at a very high multiples, right? Like when we talk about the price to earning multiples or the price to book value multiples for banks or the heavy industrial sectors. So one thing I won't be stressing much about is that you guys clearly know about that where do we use the price to earning multiples as well as the price to book value multiples. So that is something which is very much clearer to you, right? Just let me know one thing if I'm audible to all. Raghav says I'm not clearly audible. Just let me know like if it's like just the same or it's just like Raghav's issue. I'm audible, I'm audible, I'm audible. Thank you, thank you. So Raghav, I think you just need to rejoin. There might be some network issue from your end. 50 to 60 participants have clearly told me in the chat box that I am clearly visible and audible. Okay. So just log in once again and just try to change your network. Okay. No worries in that. Okay. So we all know that all the mid cap sector, the small cap sector has been overvalued. Their earnings have been good, and all these factors we know it very clearly, right? And one thing also we know it very clearly through my previous live lectures and through my modules as well. For all of those who have just started to watch my modules or watching the recordings of my live lectures, I've clearly told that where to use the price to earning multiple and where to use the price to book value multiple. Price to earning multiple is something which is universal. It can be used for all the corporates, for all the type of companies. But price to book value is something which is more used for heavy industrial companies, which have heavy intensive assets. Book values are the companies which are for the BFSI space, the banking, financial, insurance services sector space, ideally. To know more about the differences between the price to book value and price to earning, I've talked about extensively in my modules and previous live lectures. Okay. So I won't be stressing much about that fact, but about the valuation of the mid cap sector and about the small cap sector. So on a price to earning basis, if we talk about the price to earning basic being a very common metric, a universal metric on which the people tend to compare your valuations with the long-term averages. The long-term averages can be 10 years, 20 years, but ideally in terms of finance, we tend to take the long-term average being 10 years, correct? So if I particularly talk about the mid-cap space, the long-term average, the 10-year average price to earning multiple of the whole mid-cap space I'm talking about the whole index, the mid-cap index. Here, I'm not talking about one specific company. I'm talking about one index in whole, which comprises of all the mid-caps, the Nifty mid-cap index. The long-term average, the long-term 10-year price to earning average has been around 21x. 21 times earnings. That is, we are paying. If someone asks you that What do we mean by 21x times price to earning multiple? Any answers? A very common interview question as well. I'll just continue with my point once I get this answer. What do we mean by if someone says you the long-term average of the mid-cap sector has been 21x? Just type in the chat box. There are more than 550 participants. It's almost impossible for me to unmute everyone today. But the thing is, just mention in the chat box and a very common interview question as well. If someone says you, this stock or this sector is trading at a 21x price to earning multiple or at a valuation of 21x, what do we mean? Just don't give me the basic answer that the sector's average price to earning multiple is 21x. What do we mean by this? Chalo, theek hai. I'll simplify for you. What do we mean by that the sector's average price to earning multiple or the sector's long-term price to earning multiple or the sector is trading at a long-term multiple of 21x? What do we mean by that? Some people say that we are paying rupees 21, right, to earn 1 rupee. Some people say that we are paying 1 rupee to earn 21. Some people say that we are paying for its 21 years earnings. If a multiple or a stock is being trading at 21 times, we are paying for 21 years. Everyone has a different opinion. See, a very simple way to understand it is, I had like multiple answers. So first of all, we need to understand price to earning multiple. What exactly is the price to earning multiple? Like, won't be going into the depth of it because we have tried to discuss about that in the previous sessions as well. But the thing is, price to earning is nothing but when you calculate the price to earning, it is nothing but the price of a company, the current share price of the company divided by your EPS. Price is something which is forward looking. Price is something which is present in the numerator, and price is forward looking. Price is a forward indicator as per economics as well. It takes into consideration different factors, earnings, cash flows, capex, growth, even before these things have actually happened. So price is something which is forward looking, price in the numerator. Then you have the earnings per share and then in the denominator. Earnings per share is nothing but what? Where earnings per share is nothing but your how much the firm has earned or how much profit the firm has made over the profits over the outstanding shares of the company. So price being a forward indicator, EPS is not a forward indicator. So I'm explaining you this logic in detail. EPS is not a forward indicator. Some people, though ideally in financial modeling, we tend to calculate the forward EPS, forward price to earning, but that might not be the actual one when you reach to that particular stage or that particular year. EPS, actual EPS is something which is calculated when you have the actual profit after tax of the company divided by the outstanding shares of the company. You cannot be 100% sure that what is the EPS of a company after 5 years, be it JP Morgan, be it Morgan Stanley, be it Goldman Sachs, be it HSBC. No one can predict an actual number. There is always a here and there that actual year reaches for. So price being a forward-looking indicator, outstanding shares, EPS being a backward-looking indicator because it is something which you get to know when the earnings are actually there. So we have the price and we have the EPS. So on the basis of the earnings, we are paying some price for that share. Earnings, 1 rupee, correct? Earnings, 1 rupee or $1. And we are paying 21 rupees for that. Try to understand logically. Price to earning PE. The formula is price in the numerator, earnings in the denominator, which is denoted by EPS. Earnings, we have 1. So to earn 1 rupees, right? Or the earnings of the company have been 1. Ideally, to earn 1 rupees, we are paying like 21. That might not be the actual definition. It might be somewhat closer, or some people might try to understand this as the logical one also. But the thing is, for 1 earnings, if the company makes 1 rupee, we are paying 21 rupees to buy that stock. Ideally, if you talk about from an investment banking point of view, so ideally, most people also agree with this definition that if to earn 1 rupee, we are paying 21 rupees. People also agree to that definition also. But ideally, if you go depth in finance, or if someone asks you in investment banking interview for a tier one firm, you have to tell him, the question would be, what do you mean by 21x price to earning? Just give him a simple 2 to 3 liner answer if you want to explain as well. The price to earning ratio is nothing but the price being a forward indicator, the earnings denoted by the earnings per share, not being a forward indicator. So if the firm is earning something as 1 rupees, we are paying 21 rupees for that. So we are paying price 1 rupee की earnings के लिए 21 rupees का price. And the same logic I told you in my modules as well. All right. So that should be clear to you. And coming back to the mid cap, similarly, the mid cap ka long term average is 21x. If the firm makes 1 rupee, we are ready to pay 21x as per the past 10 years. But currently we are paying 26x. That is, if the firm is making 1 rupee, we are paying 26 rupees to buy that particular share. And here I'm not saying the earnings of the firm have been bad. They have been good also, right? And the small cap, 16.2x as a long-term 10-year average price to earning. And the current one is 20x. Again, we are being trading at overvaluation. But if I talk about the large cap ka long-term average is 17.6. If I just talk about the Nifty 50, long-term average is around 17 to 18. But currently it is at 19x, still at a better stage. And that is why if you hear these news channels of CNBC or Z Business, they say that the mid cap and the small cap rally is bound to get over, and something as large cap is good to go now. You should start investing into large caps. Here, I'm not recommending you any kind of stocks or sectors, which I cannot, but just in general to understand it logically. Because the large cap sector, though it is overvalued, but not so overvalued. Because there are large cap banks like HDFC Bank, Kotak Bank, ICICI Bank, their earnings are really good, cash flows and profits. But the price that they're commanding for those earnings is really less. The other sectors have grown, the other sectors have become overvalued, be it the oil and gas, the automobiles, the EV sector, the telecom sector, especially I would say the defense sector, the PSU sector. These have become overvalued. But banks are something in the large cap space, which acquire around 20 to like 25% weightage in the large cap, the Nifty 50 index. Those are still undervalued. The price has not risen so much as compared to their earnings. The earnings are good, cash flows are good. Just look at the numbers of HDFC's revenues and profits and cash flows. They have risen tremendously over the years and beat other large cap companies as well. But the price has not figured in. The price has not absorbed those cash flows and the profitability, right? So it's your take. Just try understanding the market from a different perspective, correct? And my question to you after all this discussion is, apart from yeah. So just tell me why the mid cap and the small cap sector rose so much on the YTD basis. Just don't give me the reasons that everyone was buying, so everyone bought that stock and there was irrational exuberance over what. No. Just tell me the reason conceptually that why did the mid cap and the small cap sector or the stocks rose by more than 30% and 40% respectively YTD. I just wait for 2 minutes or 3 minutes. I just want your answers in the chat box. The reason why the mid cap and the small cap sector rose tremendously. Any answers? A few of the people have started to answer. Sorry. Yeah, Umesh, Satnam, Sadbir, Shubham. Okay, okay. Any more answers? I want some more answers in the chat box. It won't be just a few of the people. Okay. So some people have told me like the reason is just on account of the earnings. The stocks have really performed well, right? Because when their cash flows were good, their earnings were good, and as a result, people were ready to pay more for that. A more reason or the second or third reason which I can see in the chat box, people say that these companies have the potential to grow. And as a result, when everything in the market is rising, then people can take that risk and the mid caps and the small caps can also rise. Because if the Nifty 50 is rising by 10%, the mid caps and the small caps give more returns, 10x, 20x times as compared to Nifty. And the vice versa is also true because these stocks have more potential. Nifty next 50 or the stocks after 250 have more potential to come in the Nifty top 50 because they are still about to expand, explore more, increase their cash flows, go for some more expansion and diversification opportunities with the large cap companies cannot ideally go for. But tell me one thing. Have the large cap companies stopped their expansion and diversification activities? Something that we study in the subject of strategy or somewhere in finance, that the large cap companies are at a declining stage. These are the mature companies which will go out. And the earlier companies which are at a growth stage will occupy their space. Does that really happen in the real life? Does that really happen in the real life? Do you really think Tata Industries will go off? Because people say Tata is a mature industry. Reliance Industry will decline or like shut down its operations. Godrej will go away. Adani will go away. HUL will go away. Nestle will go away. Do you really think these large cap, huge conglomerates for the mature companies doing businesses for more than 20 years will go away? Absolutely not. Correct, Umesh. Absolutely not. Because there's something that we study in finance that the growth companies, the companies that are the initial companies, have more way to go. And the companies which are reached at a peak point, at that bell-shaped curve, that peak point, they're about to decline because they do not do any kind of expansion opportunities, any kind of diversification work, right? That is wrong. That is absolutely wrong. In some industries like Thapar and some other, it might be good to say because these industries have not done that expansion, diversification, were not able to increase their revenues or strategize their operations. And as a result, these types of companies fall. But they're huge companies, big market cap companies, 50 companies Nifty mein बैठी हैं. Do you really think these companies are at a declining stage? Absolutely not, because every day we hear in news, these companies are going for expansions and diversifications. Ultratech Cement acquired Shanghai Cement, like this cement, XYZ Cement. These large cap companies still want to diversify and expand. That might not be there in the real life per se. Correct? So coming back to the topic of the mid cap and small cap. Just give me a second. Am I audible to all? Okay, fine. Thank you. So yeah, so coming back to the mid cap and small cap. So these reasons are completely fine. Any more reasons which I was expecting from the students is, see, we talk about the different weightages, right? The different weightages like the different sectors have. Different weightages that the different sectors have. Just a second. I'll just... See, if I talk about the different weightages, right? I talked about in the Nifty 50, the banking is having the higher weightage, highest weightage, right? The weightage being around 34 to 35%, right? After the banking sector, if we talk about the banking sector, the second weightage we have for the oil and gas sector, the IT sector per se, sorry, the IT sector is having around 13 to 14% weightage. And after that, we have the oil and gas sector. The oil and gas sector has around 10 to 11% weightage. The banking sector, the IT sector, and the oil and gas sector. Now, coming back to the mid cap space and the small cap space. If I talk about the IT sector and the financial sector, the weightage of all the companies present in India, here I'm talking about all the companies, 500, 1000 companies, 5000 companies, like which are there in India. If I talk about the Nifty, okay, they're having around 17 to like 22% weightage in Nifty 50 I'm talking about, right? Total if I talk about निफ्टी की अगर मैं बात करूं, आईटी की बात करूं, निफ्टी का वेटेज इज 34%, ठीक है, लाइक फॉर द फाइनेंशियल्स, 12 to 13% for IT, right? So that weightage, that percentage of weightage is more in the Nifty. But if we talk about the small cap space, the mid cap space, the weightage comes down. If 34% of financials has a weightage in the large cap space, in mid cap and small cap, it is lower than that 34%, 20%, 10% per se, even 5% for IT. So unka weightage is more in a higher digit number in the large cap index for financials or IT. But if I talk about three more interesting sectors, that is your industrial sectors, the consumer discretionary sector, or the material sector, right? I talked about banking and IT. Unka weightage is more in Nifty 50 in the top 50 stocks, but in the small cap and mid cap index, their weightage is less. But consumer discretionary stocks, or you have the stocks of materials or industries, they have higher weightage in mid cap and small caps sector or index. Their weightage is less. So if I just give you a number, I just like to like we were just doing some research upon these numbers, like in my company, or trying to understand why the mid cap and the small cap sector rose, right? So like we came out with such numbers. If I talk about consumer discretionary, where consumer discretionary space has a 9% weightage in Nifty 50. Consumer discretionary ka around 9% weightage hai in Nifty 50. But in the BSC mid cap, it has 15% weightage. And in BSC small cap, again, it has 15% weightage. Vice versa of the IT and financials. IT and financials ka weightage was less in BSC mid cap and small cap. But consumer discretionary ka weightage is more in BSC mid cap and small cap. We even did the research upon the industrial space. Industrials just has 5% weightage in Nifty 50, but 13% weightage in BSC mid cap and 26% weightage in BSC small cap. And the same goes for materials. Just 7.6% weightage in Nifty 50, but 13% weightage, right, in BSC mid cap and 19% weightage in BSC small cap. And these sectors have really performed well over the past YTD basis for industrials and materials. These sectors have really outperformed each and every sector because every industry requires inputs, materials, industrials, all those manufacturing working, expansion opportunities, investment opportunities, all those are related to industries. Materials is something which consists of all the raw materials for all the business, construction, manufacturing, services, because these types of industries tend to cater to all the companies, be it telecom, be it IT, be it financial, somewhere or the other, they have some link because they're providing some services. And they rose by multifolds, right? But since their weightage was more in mid cap and small cap, since their weightage was more in mid cap and small cap, so as a result, the mid cap and small cap index rose more because more percentage of weightage was there and less percentage of weightage was there in the large cap or the Nifty 50. Because Nifty 50 is mostly run by banks having a higher weightage in Nifty 50, more than 30%, IT having more than 10%, but less in mid cap and small cap, and oil and gas. Did you understand my point? Is this point clear to everyone? A new point I told, a new different point which really people would tell you. Why mid cap and small cap rose? The percentage logic. I'll be sharing these numbers with you. I'll share these numbers and I'll be posting these numbers on LinkedIn as well on with a separate post maybe next week. So that is something. The weightage of these sectors is more. And most of the emerging companies, right, are there in your industrial manufacturing, consumer discretionary space, right? Banking, mein all the companies are known. IT, mein the companies are emerging, but not so in India because the AI that is known by US or China is far more than our expectations. Some people told that China is not good to invest, like we should go for China plus one strategy and all. People are ignoring China, right? So that is my view. China is someone that has huge cash flows, far more cash flows than in India, and we should not ignore China. China will come up someday because the advancements, the inputs, the kind of work that they're doing upon AI, even the A of that has not come up in India. And we don't even know what these guys are doing into this stuff of AI. So China is really doing well. People are selling Chinese stocks and buying Indian stocks. I'm not saying that be bearish on India, sell India or buy China. There is no like kind of a stock recommendation or country kind of a recommendation which I am giving. It is just for some kind of information purpose. But Chinese market is very undervalued right now, though they have problems like problems of the property sector. So that might be something not good to go for. But the IT sector, the financial space has started to do really well and very undervalued sector, but risky as well because again the government can come up with some policies and the market can go down. So if a medium term risk someone wants to take, people can explore to China because nowadays even JP Morgan or Morgan Stanley or like Goldman Sachs have come up with ex China funds where they have increased their weightage to the other emerging economies and not China, right? India का weightage बढ़ गया, Taiwan, Indonesia, Malaysia, Russia, Vietnam. So their weightage has risen, Taiwan, right? But the weightage of China has come down. MSCI ex-China funds, your Morgan Stanley Capital International funds, right? Where this amount has been the amount or the component of China has been ignored for, right? So like very interesting topic for whatever. So just the mid cap and the small cap space, quite interesting to understand and explore for. Any questions up till now? Any questions if anyone is having? And I would suggest please watch the modules. I keep on updating the modules also. All these knowledge like which I'm sharing with you right now. A component of that is also uploaded on the website in the form of modules. I talk about currencies. I talk about the US dollar appreciation and the INR being depreciated, macroeconomic trends, PMI, CPI, inflation, inventory to sales, ratios, about export, import, macro indicators, everything I'm talking about in my modules. So please watch those modules. And a part of that, I try to frame that as a post on my LinkedIn. So you guys will have a knowledge about like understanding these macroeconomic trends, microeconomic trends, about the state of economy, right? So like recently we had the GDP numbers of the previous quarter, right? 7.6%, unexpected number, but a too high number. The market started to rise, right? And like we had your like election results in Madhya Pradesh, Chhattisgarh, and Rajasthan, right? Except like Telangana, like the BJP lost. So again, the market was rallying. Why because there was again a political stability, and because the market currently crossing 20,000 levels or 68,000 levels has been mostly on account of the domestic institutional investors. But in the previous past, the market used to rise only on account of the foreign institutional investors, FIIs. But this time, the FIIs have not invested so much. They have just invested $2 million in December, just $2 million. Earlier, they used to pour in billions and billions of dollars. But now that money has started to come back because the FIIs mostly want a stable government. And because of the BJP like winning those elections in 3 states, they believe that the BJP government will continue. The country has a stable government, so hence they can invest because the policies won't change. If Congress comes into place or some or like some different party comes into place, the policies might change. Investment policies, FDI policies, FPI policies might change. So during the time of elections in a particular country, the FIIs tend to sell those stocks till the time there is a political stability. But once they get to know, they start to invest once again. So we have the elections after 6 months or 7 months. So after 6 to 7 months, they had to invest into India once the policies were known. But now it's a pre thing. If the BJP is winning like most of the elections in states, they have that stability and they believe that BJP might win once again. So I'm not a political fan. I'm not a political expert. I'm not like promoting BJP or like Congress here, right? I just study the impact of these things on markets, right? So no kind of a political word or advice from my end. I would say like in like vote for Congress or BJP or AAP. So that is completely on you. We as investments or the people who track markets just look at the impact of these results, because ultimately we are focused towards making returns out of these market news, out of the macro trends. So that is something we focus upon. Any questions in the chat box? People who have recently joined the curriculum are asking me the difference between price to earning, price to book value, ROC, ROE. I have no problem in telling you, but I recall your names. You guys are new to the curriculum. Just watch the modules. You'll get to know about it. But still, if you don't get to know, just ping me on WhatsApp or LinkedIn. I'll be more than happy to explain you once again. But first, at least go by the process and do not binge watch the videos like the Netflix movies and shows. Like you skip and you just like binge watch things. Hear each and every line. Even if you think that one module is too simple, that I know it all, and like Moira like is just repeating such stuff, watch that. It might happen that somewhere in between, I might tell you something that would be too important because I've framed the modules in such a way. Some unexpected things might come into it. You might have heard about ROE and ROC from a definitional point of view. You might skip that module, but in that point, I've talked about from an investment banking point of view, which is completely different from BBA, BCom, MBA, CFA syllabus, which we actually practically do where I do job currently, right? So this thing you have to be very well sure about. Any questions, just let me know. I won't be extending the session long for today because I have some seminar commitments today from 5 p.m. onwards, 5:30 p.m. onwards. And most of the people have pinged me as well to not extend the session this evening because people are like more habitual of taking the session in the morning. They might have some plans. So I just like respect your personal life and everything. Maybe like tomorrow or like from next week, like we'll be having the session in the morning also. Like it was just about some prior client commitments and my ill health that I took the session in the evening. That is something. Any more questions till this point? I won't be stressing much. Any more questions? And I also posted one thing on LinkedIn. I talked about the Nifty's mid cap to small cap ratio. निफ्टी का मिड कैप टू स्मॉल कैप रेशियो एंड निफ्टी का सॉरी निफ्टी लार्ज कैप टू मिड कैप रेशियो एंड निफ्टी लार्ज कैप टू small cap ratio. So these ratios also tell us that whether the mid cap is at peak or small cap is at peak. Though they do not tell us exactly every time, but again, still a good indicator. Right? I've talked about this stuff in one of my modules and recordings of live lectures. So go through that as well. So that is one thing. So ideally, yeah. If no more questions, then guys can enjoy your evenings. I won't be disturbing you all. But कोई भी question है, just feel free to ping me. If you want to contact with me on call, please text me on WhatsApp first because there are multiple things like that are going on, and I need to take out a specific time for you guys. Okay. So feel free, watch modules, watch the recordings of live lectures, come to me with questions, come to me with tricky questions so that me as a trainer can also learn from you. So that I see you that I do not know this and I will get back to you. Right. So bring such kinds of tricky questions on my plate. Correct. So that is something which I can also work upon myself into my professional life and share with my own colleagues as well. And this thing is happening from that perspective and we can incorporate it as well. So it's a learning two ways, right? So let me know. All the best and happy Saturday evening. Okay.